Now, the Nedbank Investments Opportunity Fund is managed by Abax Investments and has a market value of 321 million rand. It was founded in 1999 and is targeted at investors requiring moderate levels of capital growth with asset allocation between equities, cash and bonds, both locally and offshore. For more, Omri Thomas, Director at Abax Investments, joins us from our Cape Town studio. Omri, thanks very much for your time. Let's start with your current asset allocation in light of the news flow that is buffering the system at the moment.
Hi there, Bronwyn. Yes, we know that this recent liquidity injection has been very good for risk assets. And for that reason, we've been overweight equities for some time. Equity valuations in itself don't look particularly attractive, but I think relative to the other opportunities, that's been our preferred asset class. So our current asset allocation, we've got about 45–50% in equities, with about 20% of that offshore and then 30% locally. And the local equity selection mostly weighted towards global cyclicals, so the materials sector, which we think is very undervalued. Then we've got about 30% in bonds and convertible bonds, and then 20% in money market instruments.
Omri, if you could just break it down for us. I see that the mandate for this particular fund you run is to beat inflation plus 5%, which is quite a high hurdle if you think that inflation is currently at about 5%. So you're looking to extract about 10% per annum over a rolling 3-year period in terms of the mandate. At this point in time, with interest rates so low, what is your, when you think about your portfolio, just take us through how you expect the different asset classes to perform going forward, and how you obviously aim to achieve that benchmark that you've set.
Warren, absolutely correct. I think we're in a very low yielding environment, and that's across asset classes. So if you look at the individual asset classes, offshore cash almost giving you nothing, local cash giving you 5%. Our bond yields have dropped to a level where you're getting 7%, just over 7% running yield. So you'll have to get a lot of your return from stock selection and from trading between the different asset classes. Within the asset classes, we still prefer equities, where we see our long-term return above 10%. But as I've said, you'll have to have quite a bit of alpha in the individual building blocks to get to that long-term target of ours of 10% or inflation plus 5%. But I think in this environment, it is going to be a tough hurdle to achieve.
I see one of the interesting things that you've done in your portfolio, which is a little different from some of the other fund managers I talked to, is that you've included convertible bonds in there, and that's typically an instrument which is initially fixed income. It gives you a yield, and then at some later stage, if the markets are running and the share prices have been rising, you elect to convert that bond into shares and ultimately sell them at some stage. Can you just inform us a little bit more around some of the convertible bonds you've been buying and their place in your portfolio?
Yes, it's a relatively new asset class in South Africa, Warren. It's we really like the payoff profile of a convertible bond. As you've correctly said, it initially operates as a convertible bond, and as the equity market rises off that specific security, it starts acting like an equity. So it's got an asymmetric risk or return payoff profile, where if the stock falls, you get your bond-like return profile, and if the stock rises, you get the equity upside. So the two convertible bonds that we've got in the fund at the moment is the Shoprite convertible bond. Now, that initially listed with a yield of 6.5%, a coupon of 6.5%, and with a conversion strike price of 130%. So in our view, that was a very low risk option to get exposure to what we perceive to be a very expensive sector, being the retail sector. So you start off with a 6.5% yield. If that sector continued to run, you started sharing in the upside. And that's exactly what happened. Shoprite ran by almost close to 30%. So you're very close to that strike level at the moment, where from year onwards you start participating in the equity upside. Similarly, the JD Group bond, the more recent one, the initial coupon at 7.5%. It's still far away from the strike, but you've still got 4.5 years left in that specific security to potentially share in the equity upside.
We've just had some information boards up while you've been speaking and looking at your exposure towards First Rand and MTN. Now, both of those stocks have run relatively hard. Omri, do you hold your position in First Rand and MTN, or are you looking to lighten your load and enjoy some of the momentum that you have to this point?
Bronwyn, we still think MTN, despite its recent run, is still offering attractive values at this level. It's still got an attractive dividend yield. They're busy doing share buybacks. It's generating fantastic cash flow. The balance sheet is still healthy, and we still think there's further room to decrease the dividend cover and increase the dividend payout ratio. So it remains one of our favorites in our portfolio. We have recently taken a bit of profits after the nice run that we've seen. The First Rand is a relatively new addition to the fund. We think the management team is very impressive and ahead of the curve. And valuations are reasonable, not particularly attractive, but reasonable, with again quite a nice dividend yield. So a nice stock to have in the portfolio.
Omri, one of the weapons in the arsenal of a manager like yours is the inflation-linked bonds, and I know from my conversations with fund managers is that was a very big component of their asset class holdings 2 or 3 years ago. What's your view on inflation in South Africa, and do those inflation-linked bonds still offer enough attraction for you in order to be able to achieve those above inflation rate returns that you've promised your investors?
Warren, it's a good question. If we look at our bond exposure, about a month or two ago, we started feeling that our nominal bonds were very overvalued, and we sold out of nominal bonds completely. We bought a lot of inflation linkers, which at that point in time still offered reasonable returns. The inflation linkers have had a good run, and we've also reduced that. But I think what we try and do in the portfolio is not have just exposure to one part of the market, and try and have a diversified portfolio. And inflation linkers plays a very important role in that regard. So at the moment, I think our exposure to inflation linkers is about 10%, which is relatively high, but we still prefer that to nominal bonds. And going forward, I think it will remain part of our diversified exposure in that sector.
I'm going back to your equity exposure here, and you've got a relatively low weighting to the retail environment, a higher weighting obviously to the resource environment. Do you think that the retail run is over then, do you, Omri?
Bronwyn, it's difficult to call. I mean, we bottom up stock pickers, and from our perspective, valuations just got a bit too extreme. So despite them having relatively defensive income and cash flow streams, the valuations, it was really priced into the valuations. Whereas in the resource sector, we started seeing a lot of value on the back of the concerns about the global macro environment. So in our view, a lot of those concerns were already discounted. So although they had operational risk, your investment risk was a lot lower, and we're offering on a probability adjusted basis reasonable returns. So that's why our preference was to go for the resource sector. Now, if we look at the last week or so, we have seen a switch out of the retail and defensive sector into the resource and global cyclical sector on the back of Bernanke's speech. It does seem that that this risk-on rally could have a bit more legs, and I won't be surprised to see the outperformance of the resource sector continuing in the near future.
Omri, besides the attraction of the resources from a valuation perspective, many fund managers have been saying that the rand may come under pressure in the future, and instead of perhaps moving out of the defensives like the SAB Millers and the BATs, they've preferred to hold those positions because of the rand hedge capability that those shares hold. What's your view in light of the labour unrest in the platinum mining sector and now that it's spread to gold for the rand going forward? Do you think the rand is vulnerable at this stage?
I definitely think there's a political risk. The political risk premium has increased. But if we look at relative to the other opportunities and the developed market currencies, they've also got a lot of problems. So in South Africa, you still get a decent yield pickup relative to international yields. So in our view, we haven't got a specific strong view on the rand. It does feel that the bias needs to be to a weakening rand, but we don't see the rand crashing out from here. But what I've learned in the past is if you want to make sure you get something wrong, is try and predict where the rand's going to be. And so we just try and pick stocks and pick stocks that will do well in either environment.